What are the risks of backtesting? Hi, it's Charlie giving you today's video. So we're going to talk a little bit about backtesting and its various forms here. Um, let's get this clear first of all. Backtesting is a very good thing to do. The title of today's video is about the risks of backtesting, but you still need to backtest if you're wanting to be trading mechanically, especially. Even if you're trading with an element of discretion, it's still good to have some base backtesting on any patterns that you're particularly using. So what are the risks with those? Well, the risks with backtesting are, of course, that you're using historical data, past data. And so there's no guarantee that what has happened previously in the market is going to happen going forwards. And so where a lot of people make mistakes is they curve fit to historical data. So what they do, and this is a natural thing, we all are susceptible to this, because we'll take a load of data. Let's take this, what I've got this up on here right now. It just doesn't matter. It's the S&P daily chart, whatever. So let's say, oh right, well yes, it pulled back here, so that was a buy point, and it pulled back to a level here, and so that was a buy point. And so what you end up doing is saying, right, okay, and you backtest in a way that will incorporate you being able to have bought every one of those lows, sort of thing. Now that's fine in this scenario, but every bull run is not going to look like this, so the pullbacks will be different. So that's an example where you've just backtested in order to curve fit to these particular pullbacks to get you an entry. And so you said, right, well, if it buys on a 3% pullback, right, that's it, that will all work, and you innocently do that. And I'm making this as a very crude example, but you innocently do that, and it's, yeah, that gives me 3 wins out of 4 or whatever. But going forwards into the future, it may not behave like that. The swings, the pullbacks may be deeper, and all sorts of things can happen. So that's just a crude example of curve fitting to some form of historical data set. And I think also what happens when people backtest, and like I said, you have to backtest. Backtesting is a good thing. I'm talking about the risks of backtesting, which is essentially curve fitting, and we do need to curve fit to some degree. And the only way of us knowing whether our backtest is going to be good going forwards is to then forward test it in a live environment. That's the only way. And even then, there are no guarantees. The amount of traders I come across who say, yeah, I backtested such and such, and it worked great in backtesting. Yeah, and actually it worked great for the first 2 months that I traded with it, and then it just fizzled out. Yeah, and that's because you've not meant to, but you've essentially curve fitted too tight. And what happens is the curve, the data going forwards, the price action going forwards is different to what has happened previously. So as an example, so you're doing a back test and you're like, right, my stop loss must be, you back test it and it's 1 times the average true range. And you backtest all these scenarios of profit taking, and you backtest 1-to-1 risk to reward, 1 to 1.1 risk to reward, 1 to 1.2, all the way down to 1.3 or whatever, or 1 to 3 should I say. And you say, oh, the 1 to 1.1 is the best risk to reward because that gives me a 59% win rate with that, and the 1 to 1.2 is no good. It's what happens is it's so fragile that there's no room for leeway on this. So if it goes 1 to 1.2, it maybe loses money, or it's very flat or whatever, and 1 to 1.1 is the same. So this is the sweet spot. That's an example of where something is over engineered, because it needs to have some flex in it. It needs to work at 1 to 1. I'm just making this up as an example. At 1 to 1.1 and 1 to 1.2 and 1 to 1.3, it needs to work across a range of in this example, risk rewards. So I'm just using the target levels as an example there. So it needs to have flex in it, and so the simpler the backtest, usually the better. The more rules and minute rules you put in, the more susceptible it is to not working in the future. It's not to say that it couldn't work, it's just that it's going to be a bit more vulnerable. The other thing with backtesting is intraday. So the lower the time frame you go to, so if you say like a 5-minute chart, the higher the risk that the backtesting won't work for you going forwards. Just because on an intraday basis, especially off of small time frame charts, you've got a lot more noise. And so where the most noise is in the intraday, and also the potential for slippage. Spreads are a bigger factor, although spreads generally are tight these days, relatively tight, but the smaller the time frame, the more a mechanical strategy is going to be susceptible to things like spreads. So what I mean by that is, if you have let's just say you've got a 1 pip spread. Okay, let's just bear with me on this. So you've got a strategy on whatever given market, and it's got and that market has a 1 pip spread. Okay, and your strategy, and you back tested it, and it's a great strategy. It looks brilliant on paper, and you're risking, let's say, and people will do this, and they'll have a 5 pip stop loss and a 10 pip target, let's say, and they'll be like, oh, look, it's great, it's a 1 to 2 risk reward, it's great. Well, okay, so if you've got a 5 pip stop loss and a 10 pip target there, well, you've got to take into consideration your spread. So on your 10 pip target, your 1 pip is 10% of your profit, which is quite a lot. So again, the system has to be robust enough to allow for, well, what about when you get 1 pip of slippage on that? Well, that's just cost you an extra 10%. So this is why I say, when you backtest an intraday, there's nothing wrong with that, but again, you have these sorts of things become a bigger factor. So the lower the time frame and the smaller the stops and targets, things like spreads become a bigger factor. Okay, so the bigger time frames, they're less of a factor, because if you're testing something, let's say on a 4-hour chart now, let's say, and so your average stop loss is, let's say, 40 pips. Well, that same 1 pip spread is much less of a percentage of and let's say your target is 80 pips. So if you get slipped by a pip, well, it's not making as much of an impact, is it, than it would be when you've got ultra tight spreads. So bear that in mind. If you're looking to backtest on small time frames, then spreads become an issue as well. But the main thing is the over engineering. And lastly, is using software. So using software is great. You could use something like Forex Tester as a auto programming piece of software. TradingView, actually, one thing with TradingView, if you're using something like TradingView charts, when you're back testing, it works on closing prices. Well, your system that you're testing may not be waiting for a close. It may just be, okay, you've got a given pattern, and when price breaks through the level, it should trigger a trade. Well, you have to be careful of this, because when you're programming with some pieces of software, such as TradingView, yes, you'll program it all in, but it won't actually take the trade until the close of the bar. Well, that may not be what you actually wanted. Yeah, so watch for stuff like that. But I think something like Forex Tester won't do that. So if you're wanting to test, do check that out. Now, the auto testing is great, but the one thing it provides you with a nice overview sheet and giving you all your stats. But what that doesn't do is help you emotionally. So just bear that in mind. So you get all these stats and it's win rate and da 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 da. But there's no substitute. You start trading it then. You've got all your back testing and you've done all of that. And then when you're in a live environment, you're looking at a chart and it's wiggling around all over the place and moving up and down. And you've got your pattern. And because you haven't manually scrolled back charts, just looking at these patterns, all you've done is just back tested it and come up with a summary, then you've not seen time and time again the way that the price moves. So there's no substitute for just going back over and over again to see, how your pattern, how price moves off that. Does it just go straight up to the target, which is unlikely all of the time? Does it go up a bit, pull back, go up again, da da da? Even on the winning trades, how does it go about doing it? And the more you spend some time, by all means, do use the automated software to give yourself that overall summary. But I would encourage you to scroll back the charts, invest the time in looking at how the price action actually works it out. Because when you're trading in real time, you're going to see all of that. The market's moving up and down, and you need to have invested yourself in seeing all of that historically on a chart, so that you can say, oh yeah, I've got experience of seeing all this. Yes, I'm used to all of this. So something to consider there as well. And that's it. I'm out of time. So the risks with backtesting, as I've pointed out, over engineering. The simpler you can make the backtest, the better. But don't let me put you off from backtesting, because it is a good exercise to do. Just bear in mind, as a risk of backtesting, it is no guarantee of what's going to happen in the future. The only way of knowing is to get on with it and then just see how it goes into the future. Hopefully they've given you some reasonable pieces of advice there today. Have a lovely weekend.